What is the state of the market today? And I'm going to start this review by looking at the RMI on the Nifty daily charts. The daily RMI has been in sell mode, developing divergences with what is happening in price. So that is the first thing to really watch out for. There is a good spike in the volume here. And this is of course the Nifty 500. So we're actually seeing broad market volume. We'll figure out what that means. But on the way up, if you see big volume, it can mean either the last round of buying into something, and then when you see a repeat of volume at a later point, so something like this, then it can mean the starting point of entry and the end point, which is an exit. Let's see if that really turns out to be the case. But moving on from the Nifty 500 to the Nifty, here we don't see the same pattern. In fact, last few days volumes completely declined. Okay, so there was very little volume in this spike. Even the big jump you saw on expiry day, no volume. So most of that volume spike which we saw in the 500 is actually coming from banking and mostly the PSU banks or PSU stocks that have been contributing in these upward spikes recently. So that is where it's really coming from. And we did of course see some mid-cap activity yesterday. Now, having said that, the situation here is still the same. The daily RMI is in sell mode. If I actually move to the weekly chart, it's slightly different because on the weekly chart, the weekly RMI is in a bullish mode, and it has developed an engulfing bull pattern as far as I can see in this candle over here, which can sometimes be a sign of further upside, but it can also be sometimes the sign of exhaustion when it occurs after a rally. So it can be what we call as the last engulfing. We'll have to see if that is the case. The resistance of course is at 18,600. The upper band here is 18,656. So that leaves open some upside for the coming week. But my sense is that we are in late stages of this move. If I look at the weekly chart, we are at the end of what would look like a corrective 5-wave move. I say corrective because we can't really mark this as an impulse when you drill down to the daily time frame structure. The same thing we are seeing here also. So we have a large third wave in between, and then you have this final move. The same thing happening here, but this is much smaller in size compared to this, though in terms of size, this is, in terms of Nifty at least, this is 61.8% of the first leg. It could very well be considered as a WXY or even an ABC broadly, where C is 61% of A. So we have reached some kind of a initial Fibonacci number where things can pause. If not, only then we consider that it moves higher. Having said that, if I really come back to the very near term, what I would want to look at is whether we get a near term pullback that is impulsive or corrective. By impulsive we mean that the fall should be 5 ways. Okay, if it's not and prices take support and start going higher, that is the only time I'll think that okay, this rally has legs and maybe we can scale all time highs and sustain them for a while. Maybe go to 19,600 or something. But right now, as I'll continue in this presentation, all the data points are clearly against it because sentiment is at a bullish extreme, something that you may have read in a recent article that was also published in the business line. And if you didn't, then I'm going to cover some of those points over here and update on the data over the last 2-3 days. So this is where we are. This is the short-term setup is that, yeah, there are divergences. The weekly setup is you're at the upper band. There is a lack of volume recently. Maybe it's shifting from large cap to mid cap because we saw broad markets pick up a little bit yesterday. And then when we move to the monthly chart here also, what we are seeing is the monthly cycle has been in sell mode all the way back from here and not turned bullish again. We did break the 20-week average here when we fell to 15,200 but recovered above it. The question is, when we look at the monthly structure, are we going to really break out of this tightening volume band to in a runaway rally, or are we going to stop somewhere and then turn down? The monthly momentum is the one that is still indicating that there is a case that prices exhaust. The momentum really completes itself like it has done on previous occasions. So it's fair to actually go back and look in time as to what happened on multiple previous occasions. Like most of these, this is the Y2K period. Once you had a sell signal, you had it play out completely before you started another bull run. Now this is an extended bull market where you keep going up by holding on to say the 20-month average or something like that, which is what happened from 2003 to 2008. So even there's whipsawing in the RMI cycle, prices continued to rise. But here, when this whipsawing occurred, we did get deep corrections. Like this correction is a 61% retracement of this initial wave, which we can then say is 1 and 2 of something, and therefore makes it much easier when you get that kind of a retracement to continue to say that, yeah, prices will continue higher, even though the momentum is whipsawing. But that has not been true again in the last 10 years. We've had these, complete cycles of momentum back and forth, and there have been divergences. So what I mean by that, and the important part to highlight is, here after prices peaked, they went sideways for a long time. You had this last rally. This last rally is where you developed a divergence in momentum and then it rolled over. Okay, the same thing again in 2018 to 20, we had multiple divergences. Prices were attempting to go again and again towards 12,000, 12,500, making minor new highs, but you had negative divergences which eventually resulted in a price correction. Even though it was COVID, it sort of helped this cycle complete itself. Now where are you? We've been in sell mode for all year. Prices are gyrating up and down, but it remains in sell mode. And so therefore, till we've really completed a full correction, and we don't know what that full correction will look like, it looks a little risky to me for me to say that, no, this is a bull market that's going to keep going on. I did try to think that 6-8 months ago, but I think the macros deteriorated and global markets deteriorated to a point where those risks, the risks outweighed the potential for a runaway bull, and therefore, unless those risks are mitigated, which I don't think they are, I'm paying attention to the monthly momentum, just like on previous occasions, thinking that it will complete what it has to on the downside. And so that means we will continue to look for where in the short term does the cycle peak. And like I said, the daily RMI is already in sell, so we're looking at peaking somewhere now. But there's now a different angle to come towards this. Why should it be peaking now in terms of sentiment? So what is sentiment? Sentiment is basically, you can take any measure of market movement, whether it's breadth, whether it's put call ratios, open interest, positioning, futures markets. How are people positioned? Are they all bullish? Are they all bearish? Are they all long? Are they all short? And that sort of gives us a deep insight into how we should look at the market at a particular point of time, whether we should be taking excessive risk when everybody is herding in a particular direction or not. Now, there's a time to herd with everybody, and then there's a time to stop and take a step back. So when we actually go to the weekly chart, what I was showing you initially, that you do see some kind of an impulsive 5-wave move here. Not impulsive, I'm saying it's corrective, but it's still 5 waves in a correction is actually W, X, Y, X, and Z, right? So there are 5 waves. It doesn't have to be 1, 2, 3, 4, 5. But when you do that, okay, so you're getting to the end of this fifth, even in a corrective structure or impulsive structure, it's going to, pause and pull back. The question is by how much? Okay, if it's completing an entire move, it will be a very big move. If it's going to go higher, it should not break certain levels or retracements and turn up again. So that is the thing we're going to watch out for over the next several days, and I'm going to write about it. But what are the odds that it actually peaks out here? And that is where we start looking for sentiment, because we are at the end of a 5-wave move, and the question is, at the end of a 5-wave move, is everybody bullish or is everybody bearish? So that takes me back to two views that I took on the market when I started to say it's a bear market. I'm going 80% cash. I put that out in the public tweets, and then the market fell to here. Here actually turned bullish, and I said, well, it's 15,200. The world is short. We're going to get a short covering rally that will be bigger than what you normally get, and could retest the trend line of all these highs. Okay, so this trend line would get retested or even broken temporarily. That was my view all the way down here, and that sort of happened. What didn't happen is you sold off immediately. Even when we reached here, we got an extremely short positioning. So what the short positioning was, like in FII data, for example, we had 1,45,000 contracts short in index futures. Over here, the number was closer to around 124, I think, or 127, 1,24,000 contracts short. And what is the situation here? Not just on this data, but a couple of other data points. So let us just go over them now chartically. I've just spoken about it. We look at the actual charts. Blue line on top that you see, this is the FII positioning that I've been talking about. And where was it after expiration? Yesterday it's come off a bit. It's around here, 73,000 contracts or something like that. The peak is 87,000 contracts on day one. How important is this number? So when we look at it from a historical perspective, especially take all the way back to 2018, this is sort of where we've been seeing peak positioning. Okay, so all the highest positions have occurred, at the top end over here. Okay, where everybody basically there are excessive long positions. Okay, so that I see this as a sentiment measure. It doesn't matter. It doesn't mean that going long is wrong. So from here to here, going long, cutting shorts and going long was a bullish trade. Because you're reducing your hedges or whatever it is from short and then going long. But whenever you reach an excess, either at the bottom end or the top end, that is where we start thinking about whether the markets are topping out or bottoming out. So what I mentioned here was extreme short positioning, okay, which is what was down here. But that's not what has happened here. We've barely come to the previous high, okay, trying to attempt an all-time high number. But we are already at this level. This level is now higher and comparable to only this or probably this. Both of which, this one was close to the January top, the second number is close to the April top. Even if we go back here, we can see multiple such occasions where, many readings close to or above 50,000 contracts, like here, midway readings, were all associated with market tops, either this top short-term correction or this top major correction. Okay, or this one short-term correction and then this one major correction and so on. This one pre-pandemic. So these are all the mid readings, this one last month from August. Now, of course, from there we did see a slightly higher high in September, but it didn't hold till the entire position was unwound. But the funny thing is, in such a small correction, we ended up with a short positioning, which was a good reason to turn bullish. So why shouldn't it be a good reason to turn bearish when everybody is long? Now, why do I say everybody? See, FIs are just one part of the sentiment trade. They just reflect what they are hedging or under hedging, and they are a large group. So when a certain large group start doing something, it sort of reflects, extrapolate into mass sentiment. It's similar to, I think only people who work in market research would understand that when you do population studies, right? You choose what is the population, you define it as this age group, this is the segmentation, and then you go and do a survey of a limited number of people who match that segmentation. So it's not like you can survey the entire country, so you do a certain portion and then you extrapolate that in terms of this is what everybody is thinking, and therefore it must mean that, and by everybody you mean that group is thinking, and therefore everybody must be thinking that way, and then you plan your marketing strategy. It's very similar extrapolation that you're doing here in the markets, that if a certain segment of the market, which is a large segment of traders, manages billions of dollars, is all bearish or bullish in positioning, it must mean something, okay? And then you match it historically. If it matches in a particular way, if it matched that, if whenever they are long it goes up, I would have said long means bullish, but historically it matches excessive longs are near the peak. And so that's all we are doing. We're just doing data analysis. We are not over reading into anything. And this is the position right now. So where's the second thing? Okay, if that was true that this is only FI and everybody else is short, okay, people would like to tell you that puri dunya mandi mein isliye market upar ja raha hai. I'll say it may have been true in October, but it's a false statement now. Why is it true and why is it false? Let's look at index premiums. What are index premiums? It's a spot to futures that you're willing to pay or rollover at, which means if you're in November, you're willing to pay a certain amount for December. If you're seeing December futures traded during November, almost up to 190 points premium in between. 4 days before expiration, we're also trading at 160 points. After expiry, we are still at 140 points premium. This is the highest premium on record. Why was there such a big premium? It means people are willing to unwind their November futures and buy December futures by paying so many points more. Is it relevant? Well, if you plot it historically, and I take an average because the raw data at the bottom, yellow, can give you spikes, but I've circled yellow spaces where those spikes reach the highs, right? Like this at the April top, you had a huge premium going up to 94 points at the start of the series. But sometimes you go into a discount like you did here. Okay, so you're at a 40-point discount where close to this bottom. Similarly, were you at a discount at 17,000 here? The answer is yes. Are you at a discount today? No, you're at the highest premium in the history of Nifty futures. Highest. What does that mean? So that means excessive bullishness of the highest degree. Okay, some people are saying why not check it in percentage terms, irrespective, because even if you compare only a 1 year, 2 year period where Nifty has been in the 18,000 range, it sort of gives you a picture, right? So I'm not going to get into micro to prove macro. But the point is, if you have the highest reading, it means something. Now, another way is to take an average, which is the green line here. I've just taken an average of the yellow line just to get a sense of where we are. And these circle points are where you had excessive, long position. So whenever there's an excess, it can mean one thing or the other. It can mean long position by strong hands that take the market up. See, this is what happened here. high premium, consolidation over, market went up, premiums went away. So there can also be an inversion sometimes between the premium and the market. But if it is happening directionally, you have a high premium at the end of a rally, it probably means that you have an over bullish market. So just at the end of the pandemic, you had the highest discount, for example, going all the way down to what is this number, around 10-20 points, which was the highest in the preceding period. And then even as the market went up, you actually saw premiums drop to an even bigger discount over here. Okay, so these numbers went completely off the charts. I'm not getting the touch point data. Yeah, it's around 20, minus 20. It went all the way down to minus 20 points in discount on average, which is quite high. On individual days, it would be even more, like here it's 57 points discount. So pretty significant. These are all the 1 month futures data. I can even look at 2 month, get similar readings that even the 2 month right now at over 200 points is a very, very high premium to really look at. Here's the 2 month premium. This is also an all-time record. Now till yesterday it was December. If you're seeing this bump up, it is because January, because 2 month is always January. So after expiry, January becomes 2 month, and that is at 240 points. Is it the highest in history? The answer is yes. This spike is an aberration in the data, so I'm ignoring that. But this is the situation. So anyway, this is one more. So this adds up, see, because all the futures position is not only FI, right? So they are not all the derivative market. So if you're getting such a big premium, somebody is willing to pay a high premium and somebody is charging for it, saying, boss, risk is very high here. I'll sell you the futures you want, but I'm going to ask you for a premium for it. That's another way of looking at it, which is how the options market behaves, right? So what is the options futures market? All of them telling us. Statistic, few people would have looked at and seen. What is the ratio of futures open interest to, options open interest? The options open interest had actually dropped to 15% of the total open interest in the market. Okay, we are talking total market, not only index. So this was the ratio at the peak of 2008. So remember when we had the bull market, the last one, the last serious bull market, people can remember 2003 or whatever, all the way to 2008. The options OI actually dropped from 50% to almost 15%, which means futures was 80%. So now in a futures only market where 80% of the open interest is in futures and everybody is buying futures, people make money through directional trades, which means direction is important, which means volatility. So you want the market to go up and you want the market to go down. That's when money is made for both buyers and sellers. So there's an interest in direction. Okay. But what's happening here is immediately after 2008, first of all, there was this big jump back to options becoming 50 to 60% of the market, which is fine, which you can see is close to what it was here at the beginning, but it was a much higher level. But what has really happened here, and here also it did happen temporarily, we went to 70%. Since the pandemic, we have gone to 80%. 80% of the market is now options open interest and only 20% is futures. So people are just not interested in the futures market, even though there is a large open interest outstanding, but they are more interested in trading options. And how do you make money in trading options? Well, the buyer would like volatility, but the seller who's providing, the trades to people who want to buy direction, they actually would like nothing to happen because they want to eat volatility. So the seller is in a situation where he wants volatility to be zero or nothing. Okay, so he wants volatility to be down. Even the market goes nowhere, he makes money because he sold you the premiums, he sold you the insurance policy, and he earns the entire premium. So this is where you see a significant reduction in volatility during this entire period as the sellers are more interested in reduced volatility. Now, is that a manipulation of markets? We don't know. It needs to be figured out. But this is what it is. The high participation in options. Now it has become delivery based. So there's a lot of hedging activity as well. Reduces the volatility somewhere in the underlying market. So you can see that's a positive thing. But it just explains why VIX readings have, remained perpetually low in India. But then don't you have options in every part of the world? In US VIX has had spikes, but those spikes come back very, very fast. So anyway, that's just the story. This is an important thing that you may want to know. But let's look at something that has direct market importance. This is a data point that I look at. Everybody looks at put call ratio, especially open interest based. I try to plot the difference between the call and put, and this is market wide again, not only Nifty. Gives you a sense of where all the buyers and sellers are. So many times when markets go up, there's more put buying or there's more put selling. I would say selling rather than buying, because the people who are interested in the market, who are smart, let's say it's the smart money, when the market's going up, they'll sell put options and earn the premium, right? You want puts, fine, here are your puts even at a lesser price. And so that results in huge put open interest, as you see down here. And on the other hand, it also shows a lot of optimism on the side of writers willing to sell record amounts of puts. That's what I used to say in 2018, 2020. I'd written so many articles on this, that at each of these stops, you had record amounts of option selling. Okay. The reverse was also true. We've seen here, we saw a lot of, selling into this rise. But later, as and when we started to get corrections, we've seen record of amount of call selling and buying both. So, of course, buying means everybody's going long. But at the same time, whenever markets are falling, there's more confidence to sell call options and, earn the premium. So, which is what we are seeing throughout this phase. But at the end of each of these counter trend bounces, what you actually see is for some period of time, there's a big spike here, which shows a lot of put selling. What happened on expiry day this week? Low volume rally in the market, because there's no big volume in the Nifty stocks, but huge open interest on the put side, which means on that one day run up, people got so interested, and boss is a runaway move. Everybody sold, put options into that expiry day, and that shows up as a spike. To me, it is a sentiment data, because each of these are related to market highs. And so that's the important takeaway for me. This one is a slightly lower reading, but at the same time, it's a breakaway from all the histogram on top, right? So, moment you got this spike down, you ended up at this peak. And that's sort of what ended up happening just 2 days ago. So again, this sort of relates with everything else I'm talking about. Here's another one that I'll probably leave you with, and there can be more. Data actually for that. It's very unusual where your FII and client positioning down here, which you see in green, is both significantly long. And so I ended up totaling the two. And I said, when did the last time we see something like this happen? And amazingly, it happened here at the peak in, I think August of 2018, before we had a pretty, I think 1500 point drop in the Nifty, and that was from a much lower level. So percentage times, I think around 11,000 something. The next one is, next very high reading is here. This is October 2000, so just before October 2000, in between September and October of 2021. Before those tops, you had the highest open interest combined between, client and FII, both of them who usually tend to have the significant positioning. And this is where we were last week, which is both of them had significantly added to the long side and were on the one side of the trade. Which should also go to explain, if there's one side of the trade on both, one is not short and the other is not long. It explains why the index futures had such a big premium, why there's so much put writing. It's all signs of optimism. So in short, what I'm saying, what I'm trying to draw in terms of a conclusion is, we are past the point where there were people who were bearish, which was at the start of October in that correction that took place. We are now at a point, all those shorts got cut through end of October, and then November there's been some buying. But now the buying has reached the point where everybody, okay, so I'm writing this down here, okay, just to everybody, okay, everybody is bullish. I'm saying this slowly so that you hear and remember. We are in a situation in the market where everybody is bullish based on market data. I don't care what you think. If you're speaking to 4 friends and they're bearish, that doesn't mean anything. If you're reading 10 Twitter posts and they're bearish, that doesn't mean anything. This is market data. If the market data says it's long, futures are at record premiums, positions are at record, then it means everybody's bullish. And that's an exact opposite of what was there a couple of months back. At the June lows, everybody was bearish. So this is the exact opposite reading that I would look for at a market high. Now, of course, you need markets to reverse course and actually confirm that there's downward momentum. But the setup here is that if everybody is bullish, that's not what I want to do. So I think that simply explains my positioning right now and my understanding why I would not go overboard on these markets, because it's slightly crazy. which is fine. But this is how we do it. Now, there's another interesting thing that I saw in the process of looking at all that is the DI positioning. DIs historically have not been big participants. But as you see over time, as with anybody in history, they start to participate a little bit, then a lot more, and a lot more on the long side, going up to 60, 70, 80,000 contracts in 2019. And then they had the biggest short position in October of 2021, September to October, just around where the market peaked last year. DIs were the max short. And this now is the second highest max short position compared to last year. So yeah, they're getting there. They don't have to have the same level. Maybe they do, maybe they don't. But this is a significant fight now. So the reason this also happened is that on expiration, but of course this was already there, so it doesn't mean only expire. Till expiration, we were like DI is a short, client and FI long. Now FI is all long. The client has cut their long positions down to 5,000 contracts. So it's now simply a fight between DI and FI. Last year, the fight ended in opposite, and it's historically FI data has always ended opposite. So I would always think that is going to be true. If FIs are all long and DIs are all short, I think the DIs are going to win based on history. Okay, apart from my Elliott wave view that the daily and monthly RMIs are in sell, and weekly we are close to the upper band and completing 5 waves. So I think summarize all of that together, this is not the right place to be bullish when everybody's excessively bullish. It's not like everybody's bullish. Everybody's excessively bullish with record positioning, record premiums across the board. So that's the main highlight. Here's the last one, which comes from Jay and my team, that the open interest in Bank Nifty at the start of the series is essentially twice of what it was at the start of the series of the last 3-4 months, and almost twice. Okay, so that's significant. It's not like 10% more or something, and that explains again the premiums. People rolled over such long positions from in banking and are willing to hold them. They're paying a premium for it, and that explains why the premiums are where they are. And the premiums also explain why options are cheap right now. Okay, so people try to figure out why the call put options were cheap as in history. Remember, for those who don't know, that pricing of options is essentially done on the basis of the futures market. Okay, so the futures price, not the spot price. So that's again a mistake. So people might think that, oh, it's the spot price. You do not calculate. Okay, so you have VIX. Okay, VIX is one part, which is volatility, which is based on the actual underlying price movement. It has nothing to do with spot and future. Okay, and it's the pricing of the option right now. And then this is so one part is volatility. Okay, so underlying volatility. Okay, but the second part is where is the futures placed? Because the pricing of the options is based on the futures price. So what happens is, if the futures price is at a premium to the spot, the puts will tend to be cheaper than the calls, or to the extent that the premiums are high. Okay, and so you'll find that call options are slightly expensive, but put options are super cheap. Now, of course, that doesn't mean call option premiums haven't come down, because VIX is down. Okay, which represents historical volatility. So because VIX has come down, okay, you do have a situation where historical volatility is pulling down premiums. But if the futures are trading at a premium, it further pulls down the pricing of the option. So you have two different things that are actually impacting the option price, and therefore you are seeing premiums go to a record low in terms of the option pricing right now. So this sort of explains another angle. Just to plot this long ago, though, it's become a little more erratic after weekly options came in. What you see at the bottom end is everything in percentage terms rather than quantitative terms. So on the top, I'm looking at the index futures position of FI is not in quantity, number of contracts, but in percentage of total open interest. And so that way, you can actually normalize data and see it being in the same range. And so where are we? We are at the top end of the range. We sort of spiked above this gray line I've drawn here, which is why I think, again, this only confirms the same thing which I'm saying, that positioning is near previous peaks. So coming back to the index, what should I be doing here in the current situation? The answer is very simple. If I'm completing something here, I can wait for some, confirmation on the daily chart in terms of trend and momentum. But the first thing I'm thinking of is something ends over here because of all this extreme sentiment and we get a pullback. Will it be small or will it be big? If it's small, which we'll have to actually see, only then you can make a case for still higher high. But the risk is, if everybody is bullish, we must be at the end of something. And if we are at the end of something, it means as much as people want this big new all-time high to make headline news, maybe you'll get headline news, maybe you won't, I don't know, doesn't matter. So even if you get headline news, bad news. If you don't get headline news, well, bad news anyway. Because the positioning suggests that irrespective we make that spike higher or not, we should be heading much lower from here. And then the question becomes, how much lower? Is it just going to be so much? Is it going to be a retest of previous lows? Is it going to be a major retracement of the entire rise? And those are the answers that I'll try and delve into as the patterns develop. But the only thing very clear to me right now is this is not a time to go gung-ho bullish when the whole crowd is doing so. That's all in this update. Thank you.